Okay, welcome back. Now let's talk again about bond yields. We've mentioned the concept of yield, and yield is essentially a return. Let's look at three return measurements relating to bonds. Coupon rate is the interest rate that's stated on the bond. This is the percentage that the bondholder will receive, the percentage of the face amount the bondholder receives on an annual basis. The current yield is calculated as the annual coupon divided by the bond price. And because the bond price is not always going to be the face amount or the par value of the bond, then the current yield won't always be the same as the coupon rate. And finally, yield to maturity is the total yield of the bond over its life. Let's look at an example of the calculation of current yield. What is the current yield of the bond in the original example? And in the original example, we had calculated a current interest payment of $156. So what is the current yield of this bond if the market price is $4,793? Now that number is given in this example. We'll talk more about how that number is calculated shortly, but let's go with that market price. We have our formula in the second line of this slide for current yield. So we want our annual interest payment. We have two payments per year of $156 each from a prior calculation. That amount divided by the market price gives us a yield of 6.51%. And if you recall, for this bond, the stated interest rate is lower than 6.51%. So note that the comparison between coupon rate and current yield in this case shows that they are not the same number. And we can look at a comparison of all three yield measurements in this slide. The coupon rate previously given, 6.24%. The current yield calculated on the last slide, 6.51%. And yield to maturity. In this case, it's given. We're not calculating this yield to maturity. I'll talk about the calculation in just a moment, but here it's given as 6.92%. We're always going to see the same relationship among coupon rate, current yield, and yield to maturity. The current yield will be the middle rate. Sometimes coupon rate is lower than yield to maturity, as we see in this example. Sometimes coupon rate is higher than yield to maturity, as we would see in other examples. But the current yield will always be between the two. In this example, we see an important relationship between yield and price. In the prior slide, we saw that the bond price, the market price, was $4,793, which is below the par value of $5,000. So the market price being lower than par value is the result of the coupon rate being lower than the market rate. And we're going to summarize this relationship in the next slide, but for now we'll simply make the observation that this bond seems to not be very attractive. It has a low price. And the reason it has a low price, in other words, the market price is less than par value. The reason for that low price is that the coupon rate is low. The coupon rate is lower than the market interest rate. In our final comment, the yield to maturity, again given. We haven't calculated the yield to maturity. In this case, it's simply given to us. Note that that is the highest yield in this example. What gives us the additional yield in yield to maturity as compared to current yield is that maturity means date of payoff. What's going to happen in the future once this bond comes due is we're going to receive the full face amount of the bond. That is $5,000. We're only paying $4,793 for the bond. So there's going to be an additional sort of bonus to us at the maturity date when we receive back more in proceeds than we originally paid for the bond. That additional bonus is reflected in the yield to maturity, and the reason that the yield to maturity is the highest of these three rates. And finally, let's talk about the behavior of bond prices. We're not going to calculate bond prices here. We're going to see the bond price calculation in our next lecture. Let's talk about the behavior of bond prices. Bond prices are driven by risk and interest rates, and when bond prices are set at the initial issuance of a bond, the price is based on risk of the entity at the time of the issue and interest rates in the market at the time of issue. And those factors don't stay static. They change over time. So as risk changes, whether it's at the level of firm or industry, or a higher macro level, which would be the economy, the political situation, the legal situation, as risk changes, then bond prices change. High risk means high yield, and low risk means low yield. Now, yield isn't the same as price, but yield drives price, and high yield means price of the bond goes down. Low yield means price of the bond goes up. Let's talk about that relationship more in the next point, the change in interest rates. If the coupon rate of a bond is high compared to the market rate, is greater than the market rate, then the pricing for that bond is going to be at a premium. When the coupon rate is high compared to the market, it's an attractive bond. It has a favorable feature, and more people will want that bond than other bond investments, so that high demand will result in premium pricing, pricing above the par value, the face amount of the bond. And the opposite situation occurs when the coupon rate is lower than or less than the market rate. That's what we saw in our example on the prior slide. The coupon rate was lower than market rate. The resulting pricing was at a discount. The face amount of the bond was $5,000, and because the coupon rate was lower than the market rate, the market price of the bond was less than $5,000. So we can generalize or summarize these relationships by stating that there is an inverse relationship between bond yield and bond price. So when a bond is initially issued and market rates go up, well, somehow that bond needs to be adjusted to yield a higher return for the investor. And the way to get a higher yield from a bond is to lower the price of the bond. Or a bond is issued at a particular interest rate and market rates go down over time, and as the market rates go down, then that bond needs to be adjusted so it has a lower yield to investors. And to make a lower yield, the price goes up. So again, the relationship between price and yield. As yield goes up, price goes down, and as yield goes down, price goes up. Now, how do all of these factors work together? We can make a general statement that risk drives rates. The higher the risk, the higher the required return or yield or rate on an investment. And rates drive bond prices, as we just stated. The higher the required rate or the higher the required yield on the bond, the lower the price an investor is going to pay. So bonds are issued at a face amount and a set fixed interest rate. Over time, market rates change, but the stated interest rate of the bond doesn't change. And the way that the bond adjusts value-wise to that change in market rates is, again, as yield goes up, as a bond yield increases, its price is going down, and as a bond yield decreases, its price is going up. Now, we can calculate, using formulas, particular bond prices based on the terms of the bond, the stated rate, the face value, the frequency of payment, and the number of years left until maturity. We can use that information to calculate the price of a bond. That calculation is a bit advanced, and we're going to look at that calculation in our next lecture.